Good day, ladies and gentlemen. As a reminder, this conference is being recorded. I would like to turn the presentation over to your host for today's call, Mr. Robert O'Connor, President and CEO of SOFTRAX Corporation. Please proceed, sir.
Thank you very much, and welcome everyone to today's webcast. As I'm sure you may know, SOFTRAX is the leading provider of revenue management solutions to hundreds of companies, and many of whom join us on the webcast today. We do have several hundred registrants for today's webcast, which indicates how much executives want to hear about today's topic from our distinguished speaker, Ken Bender, Managing Director of Software Equity Group, who is backed by popular demand to make his presentation entitled Software M&A, How the Rules Have Changed. And as always the case with our speakers on our webcast, Ken will spend some time at the end of the webcast to answer any of your questions, or as many as we can get to. Let's just take a look at quickly the agenda. I'll spend just a few minutes on SOFTRAX and how we fit into today's topic, and I'll go through that quickly. And then I'll turn the reins over to Ken, who will share his presentation as is outlined on your screen in front of you. For those of you who are unfamiliar with our webcast format, we do leave some time at the conclusion of Ken's presentation to answer some of your questions, and all of this will be completed by the top of the hour. To ask a question, just look at your console now, and you'll see Ask a Question feature. And at any time during Ken's presentation, you can ask a question and type it in there, and I'll be reading your questions throughout Ken's presentation, and I will ask them at the end as time allows. The most commonly asked question is, can I get a copy of the slides? And the answer is yes, but we do make you work a little bit for that. So at the end of our webcast, your browser will be redirected to a short online survey page. Really only takes about a minute, but we listen to these and we stage and plan our future webcasts accordingly. And so that gets you a copy of the slides, which after you see the slides, I'm sure you're going to want. It gives you a follow-up email with a link if you wanted to share this with a friend in terms of rebroadcast. And you also get Ken's report entitled The Software Industry Equity Report, the Executive Summary. So all of that for answering a few questions, and we appreciate your time on that. Just briefly on SOFTRAX and how we fit into today's topic, we do develop enterprise software that automates and helps many companies manage really all aspects of a company's revenue cycle. Throughout the U.S. and throughout the world, several hundred companies from many different industries use our software to manage their complex billing, revenue recognition, reporting, and forecasting needs. As you may know, we started by serving the complex revenue needs of software companies, and we are the clear leader in that market. And as you can see, we have grown to address the complex revenue needs in many industries. And having done this for several years and working with our customers, we worked with our customers through the boom times as well as through economic downturns, and clearly that's where we are at this point. So we wanted to share just briefly some of the experiences, and I know Ken will as well, in how to help companies manage through this, how we as a software company and consulting company play a role in this and help companies who are acquiring other companies or want to get acquired manage their business. So in some of these issues in terms of navigating through tough times, certainly all our combined customer bases are really an important aspect in managing this base, really knowing your installed base inside and out and having the information about all aspects of your installed base, from what the customers are, who the customers are, where they installed their product, what products are installed where, what level of adoption, where are products not installed, cross-sell, upsell opportunities. All of these are critical to getting to know what the opportunities are inside your install base, the maintenance contracts and so forth. So clearly one area that from an information perspective, from a systems perspective, we all need to make sure we have our hands around. Secondly, in terms of new customers, looking at new business models, as we see a lot of our customers doing now. Not only smaller changes such as different licensing and different pricing models, a lot of people are coming to market with now, but entirely different business models. Larger changes, whether they're subscription-based offerings or other types of offerings to lure new customers in today's environment. And back to systems again, certainly the changes that your executive team, marketing, and sales staff need to make have to be supported from a systems perspective. And of course, as many companies are doing now, is taking a look at streamlining processes and reducing expenses, hopefully not just with an axe, but taking a look at processes and ways of doing business differently and actually improving the ways in which we all operate and the improving the way we deliver our products and interact with our customers. And again, here automation is the key in terms of being able to get efficiencies out in terms of today's environment. However, we still see many companies who are trying to address many of these challenges with a host of disconnected systems, custom systems, and manual processes. They don't only not streamline the business, but they also create the opposite effect and layer in additional operating costs that none of us can afford in this type of environment. So this type of an approach to automation as well throughout the environment also creates problems for companies who want to acquire companies and also for companies who are looking to be acquired. So in addition to these strategic issues, using disconnected systems or manual approaches or custom systems has dramatic effects on company performance, profitability, operating efficiency, cash flow, and again, all critical if you're an acquirer or an acquiree. And if this sounds like your company in terms of disconnected systems and these issues that are confronting you, the real question in today's environment is, what is this costing you? What's the real cost of doing business this way? And you could have afforded it maybe in better times, but companies can't afford to do business like this in this environment. And a few more details in terms of key strategies that we're seeing in this environment. Obviously, optimizing all customer revenue, making sure that all license revenue companies are due, that they are getting, making sure all renewal monies and maintenance monies, making sure that the increases that are allowable by contract are being realized, making sure that for cash purposes that contracts are being co-terminated, and again, getting more cash in the door sooner. And obviously getting to know what opportunities exist in the installed base for add-on and upsell opportunities. And again, I'd have you ask yourself, do your systems allow you with this type of information that you can capitalize on? And as I mentioned earlier, a little bit more flexible billing, flexible licensing and pricing, and flexible business models are important. And we see a lot of that coming out now. Can you meet the customer requests? Can you meet the requests of the marketing and sales teams in your organizations? And again, I would ask, do your systems from a billing and revenue recognition perspective allow you to easily change licensing, pricing, and entire business models to meet the customer demand? Also, certainly at this point, information is critical. Information at people's fingertips, strategic information, operational information needed on an ongoing basis about customers and products and revenue and adoption of products. And again, to ask yourself, do your executives and principal decision makers have the information at their fingertips to make the decisions at this time? And lastly, from an operational perspective, the systems are required, certainly in finance and accounting, to be able to do more with less, from knowing the install base to the three areas of the slide. So the overall issue is, do you have the information at your fingertips? Do you have the systems that you need to support through this process of doing business in this type of environment? Our applications are organized around these strategies and can be licensed individually or a part of a suite. We have billing and operational applications from contract management, renewals, complex billing, order management, and so forth. Unparalleled revenue recognition functionality down the middle of your screen, and analytical applications that are needed to improve visibility and help make strategic decisions. And all of this functionality can be licensed in really one of two offerings. The first offering is a complete billing and revenue management solution, really targeted with deep functionality for many different industries, and many customers throughout all of these industries use our software. And secondly, for those companies who have already implemented an ERP system, whether it be any of those listed on the screen or others, our Revenue Manager product is the most robust application and very complementary to these systems, and provides a really unparalleled revenue recognition, allocation, scheduling, forecasting, and reporting. So our mission, especially in times like this, is to provide a strong ROI for our customers, and with respect to helping them capture every possible revenue stream while reducing the cost of doing so and complying all the while with regulatory issues, especially around revenue recognition. So that concludes my opening remarks. We're delighted to have Ken Bender back. Ken is the founder and managing director of Software Equity Group. During the past 25 years, he's advised, counseled, and guided thousands of software entrepreneurs, executives, and equity investors worldwide. Software Success has recognized him as the nation's leading expert in mid-cap software and internet M&A transactions. He founded the company about 17 years ago, and before that held many operating roles in the software and technology area. His resume's length would preclude me from giving him any time for remarks, so I'll cut it short. And welcome, Ken. Welcome back, and we look forward to your presentation.
Thanks very much, Bob. It's really a pleasure to be back. It's been a very interesting and difficult 2008 and 2009 on the horizon. We have some thoughts about the year that was and the year ahead. They're not necessarily the obvious thoughts. Some of it is good, and some of it is not nearly as dark-clouded as some would have you believe. We're glass half empty in our thinking, so we're not overly optimistic like a lot of analysts and investment banks are. But what I want to do for the next 40 minutes is to give you a significant amount of data. You'll be able to download this report from the SOFTRAX website, where you'll see a lot of that data, and a lot of the data is available in our reports as well. I'd like to begin by giving you just a very brief introduction to our firm. Software Equity Group is, I believe, widely acknowledged in the industry today as the software industry's leading and preeminent boutique investment bank. We represent both public and private sellers, software company sellers, software company buyers, several of the world's leading private equity firms. We have global presence, and we have advised, mentored, guided, screened, and helped bring to market altogether some 2,000 private and public software companies on 5 continents in the last 17 years. Our clients span virtually every software technology, product category, and vertical market. I think with the exception of nanotechnology, we've not done a deal there, but I'm not sure there have been any deals there. Virtually every product category and subcategory. We're small, lean, and extremely effective. We have 10 professionals. They are skilled and experienced investment bankers with DNA-level knowledge of the software industry, software markets, software technologies. We are an investment bank specializing in mergers and acquisitions and equity raises, but we publish and started publishing about 7 years ago our quarterly reports. We now publish monthly flash reports on the financial health of the software industry. Our quarterly reports are now read in 61 countries by some 15,000 subscribers. We published this morning our 2008 annual report and 2009 forecast consisting of some 55 to 60 pages. That's the only report we charge for. It's available for download from our website. I believe it's $595, but you'll understand what's in there in a couple of minutes. We're going to give you a taste of that, and this isn't a let's give them a taste and buy the report. We're going to give you a good overview of the market and the current software industry, financial health. If you want more, it is available. And then our quarterly reports, which you can register for, are available for no charge. And the last commercial, if you will, and that's just one of credibility validation. We were ranked in 2007 as number 8 among the top 10 investment banks worldwide in application software mergers and acquisitions. We believe that we'll be ranked higher this year. I guess particularly so if they don't include Goldman Sachs and Morgan Stanley and Lehman Brothers, because they're not technically investment banks. We'll see what happens. So let's get on to the agenda. We're going to give you a quick overview of what happened to public software and public SaaS company financial performance in 2008, a little bit about the economy and IT spending, which we place a great deal of emphasis on because it drives the rest of our industry. Look at software M&A by the numbers, multiples, deal and dollar volumes, and the like, and then give you an outlook for 2009. It's not just our opinion. You're going to hear from some of the head of CEOs and head of corp dev at some of the leading software companies in the country and what they have to say, and then we'll take some questions. So if we start at the top, basically, this is no surprise to anybody, your 401k portfolios reflect it. All major indices declined in 2008. SEG Software Index closely shadowed major indices. That's somewhat unusual. If you looked at that in 2004 and 2003, you'd see software either lagging or leading the other major indices. And software for the last couple of years has closely tracked the Dow and the S&P and of course, the NASDAQ, where it comprises a good segment. We've also got the SEG, and we have the SEG Software Index, which at one point was 232 public software companies. Today, because of consolidation, is 196 public software companies. And you can see specifically how the software industry, and that's North America-listed public software companies, are tracking, and they're tracking pretty darn closely to the Dow, the S&P, and the NASDAQ. We also publish the SEG Internet Index of all public Internet companies listed on the North American exchanges, and the SEG SaaS Index, which now consists of 16 companies. And you're going to take a closer look at that as well. But as the economy as a whole, consumer staples through December 31 declined only 17.2%. Financial stocks declined, as you would expect, almost 55%. And tech stocks were down 42.5%. That's very, very significant. I think you're going to see that change a good deal in 2009. I think tech stocks, even yesterday, have been somewhat buoyed. We're going to talk about why and why we believe the software industry is significantly, if not insulated, certainly not insulated, in better shape in terms of weathering a downturn in the economy, and how we believe these public software companies will perform in 2009 and why. The SaaS Index, for software as a service, for some of you who may not be familiar with the term, and this is sometimes what you'll know as cloud computing or demand computing, the median 2008 EBITDA margin of 5.5% for public SaaS companies versus 13% for the industry at large, which is really beginning to call the viability of some SaaS players, public SaaS players, into question. This is a fabulous slide. I'm not going to spend that I could spend the next 2 days on. I'll spend the next couple of minutes on it. This is the wrap-up for the software industry in North America, primarily NASDAQ and New York Stock Exchange. If you take the 196 public software companies in our tracking index, the median valuation of those software companies on an enterprise value to revenue basis fell 35% year over year, from 2.6 times enterprise value to revenue to 1.7x. That's a pretty significant decline in valuation. The median trailing 12-month revenue growth. So in the first, there you see, on the enterprise value to revenue median valuation, what you see there is a significant decline in investor confidence. And everyone is being hit by it, and certainly the software industry. But if you look at the performance of the software industry on a median trailing 12 months revenue growth basis, it slowed, but was still growing at 14.4% for the year. It did slow from 15.3% in the first quarter to 13.1% in the fourth quarter. And I think that's the trajectory. It will be down, and you'll see why in a minute. The fact is that you had a 35% decline in value, but you had 13% revenue growth, and you have to understand that translates to billions of dollars that are being spent on software. The median trailing 12 months EBITDA margin remained relatively constant in 2008, even in the face of declining revenue growth. The software industry is extraordinarily adept and positioned to handle downturns. We're going to talk about that a bit more. But when you look at variable costs, mostly labor, versus fixed costs, compared to any other industry, you have tremendous flexibility there in weathering downturns and maintaining EBITDA margins. Balance sheets remained healthy. Cash and cash equivalents increased 9% from 4Q07 to 4Q08, And debt equity ratios for the software industry, 27% versus 63% for the rest of to the other industry sectors, reflecting the lack of investment in plant and equipment and inventory and the like. Now, we've got a breakdown here, and some of you who are in some of these subcategories will want to spend more time on this slide. It's really very instructive. But revenue growth by category, so we've broken down the SEG Software Index into the composite companies in each category, which together total 196. In any one of these categories, there aren't less than 6 players, I believe, 5 or 6 players. The revenue growth by category varied from 37% for e-commerce enablement software to 3% for electronic design automation software. EBITDA margins also varied widely from 21% for financial services to 0% for CRM. Stock market returns varied from the best return of 28% year-over-year decline in stock price for database tools to a 79% year-over-year decline in stock market price for electronic design automation. And if you just look at a few of these, I mean, you look at security, 4Q07, its valuation on an enterprise value to revenue basis was 3.7x. By the end of the year, declined to 2.2x, yet it had better than 20% revenue growth in the fourth quarter and had 16.6% EBITDA growth and a 41% decline, and this is just an example. So what you have is software companies performing rather well, particularly in comparison to the rest of the world, and yet their valuations have really declined very, very significantly, even though they're growing. If you look at SaaS, which has gotten so much spin, we don't jump on a lot of bandwagons. So a year ago in our annual report and in our quarterly reports, I've written several columns on the jury's still out on SaaS, even though pretty much everybody's jumped on the bandwagon. The median SaaS valuations on an enterprise value to revenue basis, the premium for that is continuing to shrink. It was a 7.2x valuation, enterprise value to revenue valuation in 2007 versus 2.6x for the industry at large. And here we are a year later, and the SaaS enterprise value to revenue valuation multiple is now 3.3x versus 1.7x for the software industry at large in our tracking index. A lot of that is the blooms off the rose as far as a lot of investors are concerned. The revenue growth from SaaS continues to be really impressive. It's 3 times higher than traditional. Tapering off. It's down 15%. Revenue growth is down 15% in 2008 from 2007. It's not just that SaaS providers are not immune from IT spending cuts. There are a lot of people who say people are going to flock to SaaS because it's a cheaper entry prices. There's not that big one-time upfront license fee. It can be amortized over the SaaS subscription period, and all that is well and good. But we see SaaS primarily as a small, medium enterprise, a SME penetration tool, and I think the low-hanging fruit, much of it, has been picked, and that's what propelled that just fantastic revenue growth in 2007 and the first half of 2008. And I think the SME marketplace has been very, very hard hit by the economic downturn. I think that's impacting SaaS performance. And the other thing has to do with profitability, which we're going to talk to in just a few slides. If you look at the public SaaS company financial performance in 2008, for 7 of the 16 there, EBITDA margins eroded year over year rather than improved. Trailing 12-month revenue growth declined 25% from 49% to 37%. Due to slackening SME and enterprise adoption, which I just mentioned and we're going to talk more to. And investors are awarding the few SaaS providers that have both profitability and revenue growth, like Athena Health and Concur, but there's only a couple of them out there. Investors are punishing the remaining SaaS providers. The median SaaS valuation on an enterprise value to revenue basis declined for all SaaS providers was 77% in 2008. And I think that's a story that's ongoing, but we're tracking very, very closely. So we always look at the software industry and what lies ahead. If you look at the bottom left of this slide, we look very, very carefully at gross domestic product and what that growth or decline is. Look at GDP, which very much drives IT capital spending, particularly on software, which very much drives public software company performance. And when public software companies are doing well and they're being pushed by customers for more solutions, and the public software companies see more opportunities, they go out and spend it on mergers and acquisitions. And that's the kind of, from gross domestic product to IT spending to public software company performance to software M&A. So if you look at the graph, what you see is a significant decline in GDP, IT spending moving all over the place and you'll see in most cases there, as we did this overlay, a pretty quick as GDP declines, pretty much soon thereafter, IT spending declines, and if GDP picks up, you begin to see a little bit of improvement in IT spending. We follow 5 IT spending forecasts, and we look at them, we study them, we combine them. The one we particularly like is the Goldman Sachs IT Spending Survey. And as we look back at the surveys, in September of 2008, they were talking about, well, it's going to be a pretty good year, not as good as all of 2007, where we had a 7.5% increase in spending. It'll be 5.5%. Then in November, it was forecast to decline 1% globally, and now it's forecast to decline globally by 4%. That translates to billions of dollars in IT capital spending and software spending, and does not portend well. But bear in mind that's a 4% decline, and there's still going to be billions spent in IT in the coming year. How will it be spent, I guess, is the next question. As Goldman Sachs, this is the Goldman Sachs survey, really polled CIOs, they found out that cost cutting, cost containment, getting more for your buck is really where it's going to be at in terms of enterprise IT spending among the Fortune 1000 in 2009. It's focused on total cost of ownership and return on asset, and you can see that things like server virtualization and storage virtualization and WAN optimization, you're getting a picture here. It's about cost saving. And if you look down at cloud computing, application streaming, business process management, which business process management had a huge investment in terms of IT spending in 2007. Those things are going much further down on the priority list. And if you take the public software companies that are in those bottom categories, you can pretty much know that they're going to be harder hit than some of the public software companies like EMC and the like that are more in the higher categories. This slide is worth spending some time on, I believe, if you really want to begin to understand what public software companies are going to be doing next year in what categories. From a mergers and acquisitions standpoint, these are all mergers and acquisitions across all industry sectors. What you see is a clear decline in 2008. There were only 7,770 deals as composed to 10,475. You can see a very, very significant downturn in mergers and acquisitions across all industry sectors. Interesting, for the last 6 years, I believe, quarter over quarter, year over year, software has led every other industry, every other sector in mergers and acquisitions. So if you look at, now this is the software sector, North America, you'll see that indeed there was a decline. Still, software M&A activity accounted for 19% of all U.S. M&A activity in 2008, and that was up, even though the number of transactions in 2008 declined to 1,447 from 1,614 the prior year. So there was a fairly modest decline of 10%. It occurred mostly in the fourth quarter. The real question that we've got to answer is that a trajectory and we're going to see a continuing and plummeting decline in M&A activity, or was that a fourth quarter, something unique, everyone frozen in the headlights, trying to figure out exactly what's occurring? You know, it was fourth quarter that we were starting our bailouts. It was the fourth quarter mostly that a lot of the financial services institutions encountered some of their extraordinary challenges. And we'll take a look at the year ahead, and more important, give you insight and tell you why we don't believe that trajectory will be maintained. We think it's going to flatten out. We actually think that volumes will be equal and possibly better than M&A volumes in the software industry were in 2008. The rub, of course, is at what valuation. We're going to talk to that as well. M&A spending plunged 32% in 2008 from 2007, but a lot of that has to do with the $500 million and $1 billion acquisitions dropped off very, very sharply. The number of mega deals and mega deal spending declined. Mega deals declined 59%. Mega deal spending declined 46%. And so that explains a lot of the decline in M&A spending that you're seeing in that bottom chart.
Hey, Ken, we'll let you catch your breath for 10 seconds. I'll remind our audience that I am reading your questions, and people feel free to submit a question at any time during Ken's presentation, and we'll ask them as many as we can at the conclusion of his remarks.
That's great. Thanks, Bob. Yeah, we encourage that. I want to get through this so at least you've got some of the fundamental background on what's going on, what went on and what's going on. If you look at deal volume quarter by quarter, you'll see that in this slide. Deal volume did decline quite a bit in the fourth quarter to 286. We believe it will be back up in Q1, not to 402, but it will probably pass the 286. We're seeing that now, but it's only January 29th. 286 transactions in the fourth quarter, down 30% from 3Q08. But software continued to lead all other sectors, as I mentioned. M&A spending through the first 3 quarters of 2008 trailed only by about 2%. So we didn't see, you're going to see that in the next slide, a lot of variance in the valuations until the fourth quarter. And I just think that in the fourth quarter, buyers, sellers, and investors and private equity firms and VCs all were completely traumatized and just pulled back. I think people are beginning to get a clearer picture of what lies ahead, and certainly people are trying to do that. I think we had a 45-minute interview yesterday with the Wall Street Journal asking exactly those kinds of questions. From a North America software M&A activity, here I'm not going to spend a lot of time on this, but you'll see across all of the leading software subcategories and product categories exactly how that deal activity laid out. And you'll see that things like wireless and development tools and security had the most number of transactions. And verticals were extraordinarily active. I'm going to talk to verticals because we've never seen anything quite like it, vertical software company M&A, in 2 slides from now. So you may want to spend a little bit more time on that slide. I think it's pretty interesting in terms of what buyers are paying attention to. This is the slide everybody waits for, and I always hesitate to put up because if you're a software entrepreneur out there, you've just looked at the 1.9 number and multiplied your revenue by that, and you think that's what you're worth, and nothing could be further from the truth. This is a median valuation, and what we spend so much time when we meet with with software companies. And when we write and when we publish this data, particularly in our annual report, is really what's driving valuation. What could drive your valuation to 3 or to 1, and why? What those real contributing factors are. You can see in the fourth quarter that the median multiple of trailing 12 months revenue, M&A multiple, declined to 1.6. For the entire year, because of the first half of the year, it was 1.9. So there is a decline there. We don't think there's going to be a huge uptick there, but we also don't think that that's going to apply to a good number of software companies that are out there. Were they to be inclined to exit, and I think their exit multiples will be significantly higher for the reasons we're going to identify. And for others, it's going to be 1.6 and perhaps well below. The question is, which category am I in? How long will this trend continue? I want to talk about vertical versus horizontal. Historically, vertical valuations trailed horizontal, meaning enterprise apps that play across markets and infrastructure software, by some 30 to 70%, depending on the year. That trend was reversed in 2008. We are seeing more vertical transactions than absolutely ever before. I believe our annual report details that fully of all of the M&A transactions in North America software, some 37% were vertical software company mergers and acquisitions. In 1998, in 2000, that number was 6%, 7%. And the reason for that is that the larger software companies have really shifted their strategy from, I can pretend to be vertical knowledgeable and I can create a tailored vertical version of my enterprise app and really be deemed as credible in oil and gas or insurance brokerage or medical practice management. And they found out that that was not the case, that they really needed deep domain expertise. They needed somebody with credibility in the vertical. And so there was a huge consumption of vertical software companies by horizontal companies in order to gain that entree and credibility. And also some vertical consolidation as larger vertical companies consolidated and bought up smaller companies. And finally, the run-up in verticals had to do with middle market private equity firms. You've got 4 of many deals there which were vertical specific. It used to be the PE firms really didn't like verticals. Now all that nice recurring revenue, defensible strategy in a defensible market is suddenly very sexy. What you see here is the median multiples for 2008 across the product categories where we could get enough deals to really come up with a defensible and credible multiple, and they vary from less than 1x, 0.7x on ERP to 2.8x in engineering, PLM, and CAD/CAM. No categories had over 3 versus 4 categories that had over 8 in 2006. The thing I want you to take away from this slide is your product category M&A multiples change radically year over year, sometimes quarter over quarter, depending upon what's going on in the marketplace. CRM, which was high, suddenly had SaaS, and we were tracking that in a separate SaaS index, and the CRM valuations plummeted. Business intelligence with the acquisition of Cognos and some of the other big players in BI and business objects have really the BI category has really declined with the remaining players significantly. But just look at security. The median trailing multiple for revenue multiple for M&A purposes was 1.9x in 2008. It was 5.2 in 2006. Content management, 1x M&A valuation, median valuation in 2008, 3.3 in 2006. So you may want to download our reports, our quarterly reports, which are free. All you have to do is just go online and sign up. And you'll be able to track these quarter by quarter in terms of M&A performance by product category. We wanted to do it as late as possible. At the very end of December and beginning of January, we sent out surveys to over 200 public software company CEOs and corp dev heads, most of which know us pretty well. And we asked them a variety of questions. We got a very good response rate back, certainly statistically reliable, we believe. And here's a smattering. We have the full Outlook survey results in our annual report, but we wanted to give you a taste of what their plans for M&A were and why we're a little, I don't know whether upbeat's the right word, but why we are more optimistic than some that M&A volumes are going to be okay. And in terms of valuations, we'll talk to that in a second. We asked them in one question, how many acquisitions did you do last year? The next question was, well, how will the current economy affect your 2009 acquisition strategy? You can see that more than a third said we're going to acquire more. A third said we'll acquire about the same number. So that's 68% that tend to be fully acquisitive in 2009. 28% said we're going to be very careful and we'll probably acquire a few less. And very, very few said we're not going to acquire anything. The next question, which I thought you'd find particularly interesting, is are you going to place a higher premium on revenue growth or EBITDA margin? 28% said revenue growth, 72% said EBITDA margin. And that's a very important takeaway for the purpose of this webcast. In difficult times, public software companies have difficulty, obviously, because of that downstream effect of IT spending, of increasing their top-line growth. But yet they want to show growth. They do that through acquisitions to the extent that they can. And the other way that they try to restore investor confidence is by focusing on EBITDA. So SAP today, if you read the Wall Street Journal on the front page, laid off 3,000 workers, but announced that its EBITDA grew 11% in the last quarter. Software companies, because of 70% of the revenue of the typical software company. The public software companies we track is a little bit less. The private software companies we know very, very well is at 70% or more, is attributable to labor cost across all functions. And that's a variable cost that is readily adjusted when you have no other choice. And what you'll find in the software industry is that EBITDA margins are maintained very, very well. And that's what everyone's focusing on because they can't focus on top-line growth. In terms of what would you pay, though, you'll see that most of those would-be acquirers intend to pay significantly less than they did last time. And there's the rub. But I want to put some color on that. We analyzed all of the deals that all of those respondents did last year and came up, respondent by respondent, with multiples that we were really surprised at. Surprised meaning they were very high multiples. When you discount by this 10 to 20, 21 to 30%, 31 to 40%, you're still in multiple ranges that are extremely attractive to many, many software entrepreneurs, above 2x, above 2.5x in some cases. So I think you may want to get some more detail from our annual report on that score. So what do you do if you're a software entrepreneur or private software investor in the current market to stay alive and position yourself to exit, whether that's now or 3 years from now? We believe that because of our survey, because of everything we're tracking, more important, because of the conversations we're having with scores and scores of public software companies and private equity firms who have significant portfolios that they want to build and protect, that you may well remain highly attractive in 2009 if you're deemed strategic to an acquirer. Beauty is in the eyes of the beholder. And if you are EBITDA accretive. If you're losing $9 million on $10 million of revenue, you're not going to be acquired in 2009 until that issue is addressed, no matter how strategic you are, just because of the reason I gave you before. The spotlight of the investor analyst community on the software world has now shifted from revenue growth to EBITDA. Dilutive acquisitions are going to be very, very few and far between until revenue growth is restored, and that may not for the big software companies, and that probably won't happen in all of 2009 in our view. So for the others who aren't highly strategic and accretive, batten the hatches. You could make no fundamental changes and weather the storm, and that's what private software company entrepreneurs generally do. Or you could use the time to address people, departments, and take steps to improve your EBITDA. A $10 million typical, $10 to $15 million privately held software company has an EBITDA margin of about 15%, and it has a compounded annual growth rate of about 12 to 14%. We believe that can be significantly improved, and we don't do it. I've owned and run 3 software companies. I understand the operational challenges as well as, standing on the outside giving advice. But we would urge every software entrepreneur on this line to do a CAT scan of your 2008 financial statements. You review them every month, but now is the time to lock yourself away for a day and really begin to review your financial performance and where it can be improved. Analyze every cost component and every expense. And it's probably labor expense, just like the software companies, where that's going to be addressed. We urge you to address 2 particular departments. Sales, which has always been the Achilles heel of the privately held software company, even the successful ones that have been in business for 25 years, figuring out how to sell, whether they should be using telesales as lead generation, and how to do that effectively. And I know people out there are saying, well, we tried that, it didn't work. We see company after company that does this, not just telesales, does sales, software sales, enterprise and SME sales out of the box, and it can work phenomenally well to drive those CAGRs, those compounded annual growth rates, from 12 to 14% to 30 and 40%, even in seemingly staid markets. The sales organization, your quotas, your sales compensation system, your pricing are all issues that we would urge you to take a very, very careful look at. And development, which I call sacrosanct but not saintly, is usually very ripe for restructuring, and it's something you've likely ducked because when the revenue comes in and the profit margins hold, you don't want to have to bite those bullets, but it may well be time to do so now. We also believe, and I know this seems counterintuitive, that there is opportunity for revenue enhancement here by scrutinizing your prices, your margins, the relative revenue contribution of your products, and there's a great deal that can be done to clean up your revenue streams and perhaps enhance them, including beginning, which you may not have done, auditing some of your customers to determine whether new users, if you charge on a desktop basis, have been added. There's upsell opportunities even in down markets for software companies. I'd love to spend more time on that, but we're about out of time. I wanted to just leave you with a couple of other thoughts. 1,680 software M&A transactions in 2008. Last year at this time on this webcast and in our annual report, we predicted 1,600. We weren't too far off. We didn't quite see the debacle of 4Q08. The median multiple of M&A revenue multiple was 2.2 in 2008. We projected, we projected 1.9. We projected 2.2, and it was actually 1.9. We believe that EBITDA growth rates and EBITDA margins would decline by 15 to 20%. They held steady. Adoption rates for SaaS would slow as GDP and IT spending slowed. I think we were okay. We were right there. IPs would decline by 50%. We saw a steep slope, but it fell off a cliff. The IP markets are thoroughly summarized in who's in the pipeline and what that's looking like for the future in our annual report. Here's what we think about 2009. We believe that there'll be under 1,400 software M&A transactions. We believe that the median multiple will be 1.8 trailing 12 months revenue. We believe that public software company growth rates will decline about somewhere between 4 and 11 growth rates, 4%, and EBITDA margins to 11%, and that SaaS valuations will continue to decline further, significantly further. That IPOs will remain stagnant, 2 to 3 in all of 2009. I hope we're wrong. That large LBOs will be non-existent. One last concluding thought, and then we'll take some questions. We selectively mentor 10 and 20 and $50 million software companies that are not ready for exit but want this kind of insight, want to be able to sit down with our team. There's usually 5 or 6 of us in a room, and really think through their strategy and get some guidance and do that on an ongoing basis. There's no obligation. We don't charge for it. 1 year or 1 month or 3 years from now, should you decide to go out, you can choose any investment bank you want. We believe, having worked with us, you won't be so inclined. So if you're interested in our mentoring program, take a look at that slide after the webcast, and don't hesitate to call us, and we can have an offline chat. That's something we've been doing for a lot of years. We're currently mentoring 75 companies in about 11 countries, I believe. So that's my part of the webcast today. Bob, I'm going to turn this back to you, and let's see if we can take some questions.
Yeah, we can. We certainly have enough. We can't get to them all, and I will, at the end, really at the top of the hour, I'll give the instructions again for getting copies of the slides. People continue to ask that question, and we'll take care of that in about 6 minutes or so. Let's rapid fire these if we can, Ken. So one question is, as you take a look at multiples for public companies versus M&A multiples, is there a lag or with respect to the M&A multiples of public companies and then M&A multiples for people to watch, and does that necessarily change in terms of the lag time during upticks or downturns?
Got it. Look, when a public software company has a 2.4x in the first half enterprise value to revenue multiple in the first half of 2008, and it drops to 1.4, and they want to do an acquisition, and you come along, first of all, you have to be highly strategic for them to want to have a very serious conversation with you. And that doesn't mean that they won't pay 2.5 or 3 or 3.5x. But with their valuation now at 1.4, they've got to justify to their investors, to their board, why they would be paying double their valuation as a billion-dollar company to a small privately held company or a small public company. So you have to be that much more strategic. So yes, there is an impact on M&A valuations of public software company valuations. Yes, it will be a reality check for them. But yes, often if you're deemed strategic in this market, you're going to have to be deemed that much more strategic than you were in 2007.
A lot of SaaS questions. A lot of our customers are SaaS companies, and so we have a lot of SaaS questions. I'll just boil them down into kind of one long question for you to address all together. So you've talked about the decline in terms of SaaS companies getting closer to traditional software companies. Do you think that bubble has burst forever and therefore they'll stay close over time, or do you think that they'll start to distance themselves again when the market recovers? And the second half of that is, what are Athena and Concur doing differently that's making them outperform the others with respect to profitability?
Wow, that's a separate seminar, but let me give it
you have about a minute. Go ahead.
Particularly that last question. It's a fabulous question. We believe that SaaS is an extraordinarily viable and opportune means of deployment of software. Two things about SaaS. Number one, it is the best SME penetration tool out there as far as software is concerned. But that doesn't mean that every small, medium enterprise is going to adopt a new software solution, even if it's easier to do and you don't have to ramp up an IT department. We believe the low-hanging fruit has been picked. We believe that SME has been hard hit, but it will come back. And when it comes back, there'll be more low-hanging fruit, and SaaS will remain very, very viable in the market, in that marketplace. It's SaaS in the enterprise that we continue to question, and we see all of these pundits and analysts just dismiss it. But the CIOs we talk to, the surveys we look at, say that there's two remaining issues that SaaS still hasn't satisfied for the enterprise. Number one, security. Number two, integration with back-office applications. And number three, why I should offload outside my firewall a really mission-critical, when I've got hundreds of servers inside my firewall with a good IT department. Yeah, I can do it for onboarding, hiring software. I can do it for expense management software. That is an enterprise I can do as a SaaS model. But I don't still see a compelling value proposition, and there are those two risk factors that are holding CIOs back.
Okay.
And just quickly,
yep.
and the reason why Athena and others, there is this tremendous dual focus on both revenue growth and on profitability, and making sure that the SaaS pricing model, and that's a separate seminar as well, the SaaS pricing model is such that it's not so amortized that you don't have enough upfront to start driving revenue. SaaS pricing is an art and a science that most software entrepreneurs who are SaaS providers or hybrid providers have not mastered yet. We have a lot of thoughts on that pricing strategy, subscription pricing strategy.
How do the private equity firms play into your forecast for your outlook for 2009?
The LBOs are gone. The private equity firms, and they're the second-tier firms generally, and some of the first-tier firms that have large, what we call platform companies that they spend $1 billion for, $500 million for, $5 billion for, that are now taken private and privately held. They are still looking to do tuck-in acquisitions. But right now, they leverage some of those LBOs were leveraged to 8 times EBITDA. In a declining market, you want to make sure you can pay the debt service. You want to make sure that there's enough balance sheet cash to act as a cushion. And if you can get past those obstacles, you're going to do tuck-in acquisitions. You won't see those PE firm tuck-ins at $100 and $200 million. But they are aggressively looking for. They contact us at the rate of 3 to 4 a day, looking for tuck-in acquisitions that are strategic and under $50, $60 million to leverage their existing portfolio companies, platform companies.
Last question, the $800 billion question. What do you think the effect of the Stimulus Act on software companies, technology companies in general?
The question is, nobody knows the answer to that. Is any of that going to flow through to IT spending? If nobody's doing IT capital spending on software, if that's significantly declined and those enterprises are not buying software, then I think the software industry is in for a difficult time. That said, just remember how adept we are at keeping profitability high. It's going to be through layoffs. I believe layoffs are tragic. Tens of thousands of lives are being affected in our industry right now. But it is a way of preserving the health of the industry. It makes a very rapid comeback when you're profitable, you got cash on your balance sheet, and now things begin to turn, and that's what you're going to see.
All right, we're up against the clock. Ken, thank you very much for sharing your insight with our audience today. I want to thank our audience for your time today, and thank you for all your questions. We probably got 100 of them, so it wouldn't be possible to get to all of them, so I apologize for that. But I'm glad we were able to get to the ones we did on revenuerecognition.com. As you take a look at your screen now, there is a forum for you to ask each other questions, and certainly feel free to visit that site often to share your thoughts with your colleagues. I'll remind all of you that we need about a minute of your time to complete a questionnaire, and your screen will shortly show you that URL. That'll get you copies of Ken's slides, a link to the rebroadcast, and the executive summary of the Software Industry Equity Report. And that link is now on your screen, so please go there for all of those. And please stay tuned to your email, SOFTRAX.com, RevenueRecognition.com, for future executive webcasts and other relevant events. And again, thank you very much, and thank you to everyone. Goodbye now.